Well, now we'll come to the next adjustment, that is depreciation. If we understand the term depreciation, guys, gradual but permanent decrease in the value of non-current asset is termed as depreciation. We charge depreciation because of use of the asset, change in technology, obsolescence, passage of time. Well, students, depreciation is charged at the end of the year generally. Now let us understand this with adjustment. We'll take one trial balance as on 31st March 20. In trial balance, plant and machinery given on debit side is 80,000. Furniture given on debit side is 40,000. Below furniture in bracket, they have given original cost is 60,000. Now, adjustment says that charge depreciation on plant and machinery at 10% per annum by written down value method, that is WDV method. The next adjustment, charge depreciation on furniture at 5% by straight line method. Well, before we go to the effects of these adjustments, we'll understand few basic points. The values which are given in trial balance of non-current assets like plant and machinery 80,000, furniture 40,000, these values, they are not the original cost. They are written down value, book values. So students, remember that the values which are given in trial balance of non-current assets, they are written down values, book values. They are not original cost of the assets. Here, the method which is given of depreciation is on plant we have to charge by written down value method, and on furniture we have to charge by straight line method. Students, we have already discussed there are different methods to charge depreciation, but in 11th standard we cover two methods, that is written down value method and straight line method. Well, under written down value method, the depreciation is charged on the written down value of the asset, book value of the asset. Whereas under straight line method, the depreciation is charged on the original cost of the asset. In case of furniture, we have to charge depreciation by straight line method. So in trial balance, below furniture, they have given us original cost. Now, if we see the effects, we'll take profit and loss account and balance sheet. First, we post the trial balance items, plant and machinery on asset side, non-current assets, inner column 80,000, furniture, asset side, non-current asset, inner column 40,000. First adjustment, we have to charge 10% depreciation on plant by WDV method. So if we calculate depreciation, the WDV of plant and machinery is 80,000. We take 10% of 80,000. So depreciation comes to 8,000 rupees. Now two effects. One effect we take to profit and loss account, debit side. 2. Depreciation, plant and machinery 8,000. Second effect, we deduct depreciation from plant and machinery in balance sheet asset side. The next adjustment is charge depreciation on furniture at 5% by straight line method. So if we calculate depreciation, the original cost of furniture is 60,000. If we take 5% of that, it comes to 3,000. So depreciation on furniture is 3,000. Again, two effects. One is profit and loss account debit side, 2 depreciation on furniture 3,000. The other effect is balance sheet asset side. From furniture we will deduct depreciation 3000. Well, if in question sometimes they give depreciation on assets directly in trial balance, it is not given as an adjustment, but it is given directly in trial balance. In that case, it has only one effect, and this depreciation on assets is posted in profit and loss account debit side. Well, if the question is of manufacturing entity, in that case, depreciation on plant and machinery and depreciation on factory building is not taken to profit and loss account, but instead depreciation on these two items, they are taken to trading account as a part of manufacturing cost. So do remember, if the question is of manufacturing entities, in that case depreciation on plant and machinery and factory building, one effect, instead of profit and loss account, it goes to trading account, and the other effect remains as it is, that is, we deduct this depreciation from the respective assets in balance sheet asset side. Well, now we'll go to the next group of adjustments which are on goods. The first adjustment in this group is credit purchases unrecorded. Well, if we think of journal entry of credit purchase of goods, the journal entry is purchase account debit to creditors. Now if we see the effects of this adjustment, we'll take trading account, we'll take balance sheet. In trading account, two purchases we record on debit side, and in balance sheet, creditors we record in current liabilities. Well, the adjustment was credit purchases unrecorded, and the journal entry we passed was purchase account debit to creditors. Well, the first effect we give is we add with purchases in trading account, and the second effect we give is we add with creditors in balance sheet. The next adjustment we'll take on goods is credit sales unrecorded. Well, if we think about the journal entry of credit sale of goods, it is debtors account debit to sales account. Well, we'll understand the effects. We'll take trading account, we'll take balance sheet. In trading account, credit side we post sales, in balance sheet asset side, in current assets we post debtors. Now the adjustment is credit sales unrecorded. So we'll record it. In trading account, the first effect we'll give is we'll add with sales, and the second effect we give is in balance sheet we add with debtors. So two effects of credit sales unrecorded is you add with sales in trading account and you add with debtors in balance sheet asset side. Well, the next adjustment on goods we'll take is goods distributed as free samples not recorded. Well, if we think about journal entry, it is advertisement account debit या sample expenses account debit to purchase account. So it affects our trading account and profit and loss account. Now if we understand the effects in financial statements, let us take trading account, let us take profit and loss account. The first effect is we deduct from purchases goods distributed as free samples, and the second effect we show as an advertisement expense या sample expenses in profit and loss account debit side. So two effects of these adjustments will be, first effect deduct from purchases in trading account, and the second is you show as advertisement expense या sample expense in profit and loss account. The next adjustment on goods we'll take is goods withdrawn by the owner for personal use not recorded in the books. Well, again, if we think about the journal entry is drawings account debit to purchase account. So it affects balance sheet, it affects trading account. We'll understand the effects. We'll take trading account, we'll take balance sheet. The first effect, from purchases in trading account, we deduct less goods withdrawn for personal use. The second effect we take in balance sheet, liability side, from capital, we deduct less goods withdrawn for personal use. We are taking as if they are our drawings. So, two effects of these adjustments are, the first effect we deduct from purchases in trading account, and the second effect we take as drawings and we deduct from capital in balance sheet. Now we'll take the next adjustment on goods, that is goods destroyed by fire. Yeah, goods destroyed by accident. Well, if we talk about the journal entry of this transaction, there are two possibilities: goods destroyed and there is an insurance cover. In that case, the journal entry will be insurance company या insurance claim account debited by the amount which is to be received from insurance company. If there is any loss that goes to profit and loss account debit, and the total value of goods destroyed will be credited to purchase account. So journal entry will be insurance claim account debit, profit and loss account debit to purchase account. But say if there is no insurance coverage, in that case the entire goods destroyed becomes our loss and it gets debited to profit and loss account. So in that case the journal entry will be profit and loss account debit to purchase account. Well, this will understand with a numerical. We'll take this adjustment. Say goods of rupees 10,000 destroyed by fire and insurance claim admitted 80%. So total goods destroyed is 10,000. Out of that, insurance claim admitted is 80%, that means 8,000. So there was a loss of 2,000. Now if we talk about the journal entry of this transaction, insurance claim account debit 8,000, profit and loss account debit 2,000, and to purchase account 10,000. Well, if we see the effects of this adjustment in financial statements, this adjustment affects our trading, profit and loss and balance sheet. Well, in trading account, from purchases, we deduct total value of goods destroyed by fire, that is 10,000. Loss of 2,000 will debit in profit and loss account, and the amount which we have to receive from insurance company, 8,000 rupees, that we will show as our current asset. So, three effects of this adjustment: trading account, from purchases we deduct goods destroyed by fire 10,000, P&L account debit side loss by fire 2,000, and balance sheet current assets we record insurance claim 8,000.